guys for joining us both in person and online. We are so grateful that you've joined us today. I don't know if you're not quite familiar with Paperchase. We are an accounting firm for restaurants. We've been around for over 30 years, and we service restaurants across the globe, across the United States, Europe, UK, Middle East, and we service restaurants of all different kinds. So, small restaurants, chef-driven concepts, fine dining like Daniel Boulud, even fast food like Five Guys, Halal Guys. But what really connects all of these restaurants is that they have a desire to grow and to expand. And so similarly, we want to have the opportunity to grow and expand our clients' employees' careers. And so that's why we're doing this today, is we truly believe that everybody in this room and online is the future generation of hospitality. So we're with the future managers, the future restaurant owners, the future bar managers. And we have found that when we are able to empower our clients' teams with financial tools and resources, they're able to do better, not just for the business that they're at right now, but also to grow their careers, right? Like knowing a P&L is something that you will need no matter if you decide to stop working in the restaurant industry. It's something that is truly a skill. And so we just want to see restaurants succeed and grow. And so that's why we've asked you all to join us today. I'm super excited to introduce our two hosts this afternoon. So I'm just going to show the agenda really quickly, which is what we'll be going over. So I'd like to introduce Ruhel and Giselle to the panel. Giselle, you want to start us off?
Oh, hello there. Good morning. Welcome to our first webinar. I am an operator. I'm not an accountant. I've been working with restaurants for more than 25 years. I have worked in Europe, in Asia, in Africa, and here in the US. And I have worked with Paperchase for more than 20 years in all these places. So I know their product really well, and now I work with them. But being an operator, I learned very soon, very early in my career, that knowing financial data, understanding the P&L, understanding weekly reports was extremely important for me to manage a profitable restaurant. So that's why we're going to try and help you today to improve your skills in terms of financial data and also the operations. Thank you.
Thank you, Giselle. Hi, everyone. Good morning. Thank you all for being here in person, also via the webinar. We're all excited to have you here today. My name is Ruhel. I've been with Paperchase for 8 years now. Prior to Paperchase, I was in the hospitality sector, working in various restaurants and nightclubs while pursuing my degree in accounting. Vast majority of my career has been in the industry, so I know a little bit about operations, also be able to apply when it comes to, without the end of it, right? I'm excited to be here, and thank you all for being here.
Thanks.
Of course. So to start us off, we have a poll questions for everyone in the webinar. Also, feel free to chime in here in person. What does a successful GM, what skills does a successful general manager have? So we'll take a second for everyone in the webinar to go ahead and answer the poll. In person, anyone want to go ahead, take a shot?
Be able to jump into any role that requires.
Absolutely.
Expenses.
Yeah.
That's a must. That's a must.
What was that?
Time management.
Time management.
That's definitely on top of the list. Anything on the webinar, Mitch?
So someone says time management, managing people, another time management, being diverse, being flexible.
All of it, all the
Love
above, right? So why don't we ask our specialist, Giselle? Giselle, what do you think?
All right. When I'm hiring a general manager, there are some things that I look for. One is leadership skills, obviously, attention to detail, and being able to think on their feet. A general manager means you are in charge of the whole location. So that means you need to know what's happening in the kitchen, in the bar, in the restaurant, and you need to think very quickly. And if there is a problem, you need to find a solution very quickly. But one of the most important skills for me to hire a general manager or to promote a general manager is their financial skills. Do they understand weekly reports? Are they interested? Most importantly, do they want to know? Do they want to know every Monday how they did the previous week? Do they want to find out, what their labor cost is? All this is extremely important. So if you want to grow in your career in this business, understanding financial data is going to be one of the priorities. Now, how does financial data impact operations? That's something that a lot of people don't realize. They look at the sales and they say, okay, I had a good week last week. Everything is fine. Sometimes you guys don't have access to a P&L account. You don't have weekly reports, maybe. So all you see is that you made a lot of money last week. You worked very hard, your team worked very hard, but how that impacted the bottom line, right? Because the most important thing in the end will be the bottom line. Any business, it needs to be profitable. So which are the KPIs that impact that bottom line? Now, KPI is a key performance indicator. It's something that is very important on financial data. These are the main points that you're going to be looking at to improve your business, to manage your business, to improve operations. So which are the controllable KPIs that you have in your hands that you can manage to improve your operations? One is average spend, two is labor cost, and three is food and beverage cost. Now, average spend, a lot of people look at the weekly, they know what their average spend is, but they don't know what to do with it. And we will talk a little bit more about that later on. Labor cost is something that everybody's struggling nowadays. So I'm sure your bosses are coming to you and say, you need to cut labor, you need to cut labor, you need to achieve your target on labor. Food and beverage costs, extremely important, because that's what your purchases are. If you buy the same amount of beer and wine every week, that will affect your cost. You need to buy depending on your business, in line with what you're selling. So all these KPIs are going to be very important in your career. Now, one of the most important reports is called the profit and loss account, the P&L. And Ruhel is going to take you through a P&L and show you how it works and how you can read it.
So one key thing that Giselle mentioned is a top line and a bottom line, right? But that's not it. The P&L consists of everything else. So what goes in between the top line and the bottom line, which is essentially the key metrics that we want to look at. So what is a P&L? P&L, a profit and loss statement or an income statement, also referred to as, right? This is everything within the four walls that happens in a restaurant. Anything when it comes to starting with the revenue, the cash that you're generating, the income that you're generating as a business, right? So it starts off with the revenue, then it goes down. So everything else after that is essentially going to be some sort of expense, right? So moving on to some of the big ticket items on your P&L we'll start off with the COGS, which is the cost of goods sold. This is again just your cost of goods sold for food and beverage, nothing else. So it's your groceries, your produces, your meat, seafood, etc. Right? Moving down to the labor cost. The labor cost is our people. We need to employ our people. We got to pay our people, right? So whether it's somebody who's a salaried employee or hourly employee, everything else will show up under your labor cost. Then comes everything else, your supplies, utility bills, etc. Right? So those are otherwise. Last but not least is your net income. So you subtract all your expenses. What you're left with is your net income. If you're profitable, it's going to say net profit. If you're not profitable, it's going to say net loss. So what we're doing is we're breaking the P&L down into a couple of segments, right? One key indicator, well, there are a couple of key indicators. One that we'll show here is called the gross profit. You may ask yourself, what is a gross profit, right? Gross profit is essentially revenue minus your cost of goods sold. Again, cost of goods sold or expense when it comes to food and beverage invoices. So they're your Cisco's, the Ballors, the Empire Merchants, the Southerns, etc. Right? So the quick calculation for gross profit is revenue minus cost of goods sold strictly. That gives you a margin of gross profit. Generally speaking, we want to keep the cost right around 25%, depending on concept, like Giselle mentioned. If you're fast casual or QSR, your food cost may be on the lower side. If you're a fine dining, it may be upwards of 25, 28, even to 30%. But again, it caters to your concept, right? So gross profit, that's how we calculate a gross profit. It's a key metric that operators and you, the manager, should always be looking at. Another key metric that we use in this industry is prime cost. So it's slightly different from gross profit. Only addition to the prime cost is we're adding the labor cost to it, right? So it's your revenue minus your cost of goods sold minus your labor expense. That gives you the prime cost. The reason why we call it the prime cost is these are cost of goods sold, labor costs essentially takes up about 2/3 of your P&L when it comes to expenditures, right? So therefore, it's also known as the prime cost because you want to be able to control those, and those are easily controllable, right? Again, I'm just going to introduce the topic of controllable expenses and fixed expenses because some are controllable, some are fixed. There's no way around it, like rent, for example, but we're going to obviously introduce that a little bit. So to summarize it all up, Profitability metrics. These are key indicators for all you operators, managers, also us the accountants, right? We look at these metrics to be able to gauge how a business is operating. So again, we discussed gross profit. It's revenue minus F&B cost, which is food and beverage cost. Prime cost is your revenue minus your F&B cost minus your labor cost. That tells you how you're operating, especially with the top lines. Net profit is your revenue minus all expenditures, including your labor and operating expenses. Another thing is EBITDA, right? Now you may ask yourself, what is Ruhel talking about? What is an EBITDA? EBITDA is earnings before interest, tax, depreciation, and amortization. That's exactly what it stands for. In the restaurant industry, we call it four-wall EBITDA. Anything that's within your realm of control, that is called a four-wall EBITDA. So anything, depreciation is something that you cannot control as an operator. You cannot limit that. It's tax adjustments, CPA is going to handle it. But everything else that happens within the premises that are under control are going to show up in your four-wall EBITDA financials. And we'll later introduce that when we go over the P&L as well.
All right, so we have a question for everybody. Who here has seen a P&L? Have you guys looked at a P&L? Do you feel pretty comfortable with it? Awesome.
Sometimes it looks good, sometimes.
Looks like people are still coming in, but we've got about 87% have seen, we're going down to 80, and then 20, it's about 80-20, yes, no.
But the 20 is definitely a big number, right?
Yeah,
So-
20 is no, yeah.
Yeah.
80 haven't seen or 80?
80 has 77 now, yeah.
Awesome. All right,
Yeah.
so let's look at one together.
Yes.
Sharing.
All right, so Caroline pulls that up. Profit or statement, whether you're in the hospitality sector, retail sector, marketing, everyone knows, everyone needs to know at least how a P&L operates or what it looks like, right? We're often given budgets based on the P&L, based on our performances, etc. Some of us may even be, given a bonus depending on how we perform, right? Some managers have bonus kickers for maintaining a good labor cost or maintaining a good cost of goods sold, right? So before we go into numbers, we want to show you some graphs and bars. So hopefully we can get you all excited. Again, numbers sometimes can be boring depending on how you look at it, but once you are able to make a story out of the numbers, it's magical, right? So let's look at some graphs here so at least we can understand what's going on and before we go into the actual data itself. So on the top left, we have a sales analysis, which comes in a standardized P&L format for pretty much all the financials that we roll out for our clients. It gives you an analysis of sales for the entire year. So if you go from the top left all the way over to the top right, you will see January to December. And again, this is a comparison for year over year, month over month, right? So we're just looking at the top line sales for this restaurant for an entire year, and we're comparing month to a month, which is essentially comparing apples to apples. So as you can see, we're looking at trends, right? Jan, heavy fluctuation, like the sales on the top left is in thousands, and then we have the months. The green bars represent 2023, the blue bars represent 2022. So as you can see, January sales definitely where we did, we did 4 times the numbers in a way, right? Which is fantastic. But after that, it's sort of flatlines. It's about the same month over month, not much going on there, right? And then we see as soon as the summer ends, right around August, it takes a spike up both year in 2022 and also 2023. So that tells us that, people are back in town, kids are back to school, people are going out, spending money, etc., right? So that is a key metric. I mean, you want to look at it because you want to be able to visualize it. So say, for example, the month of October now, year over year, we see a significantly decrease in revenue. That is a concern. Why is that happening? Is it less foot traffic? Is it because of less reservations? If so, maybe our marketing team has to do a better job, right? So again, these are not going to give you the full story unless you look at the data itself, but at least it gives you a starter, right? Moving on over to the next graph. Again, this is just a staff cost, right? So we want to see this number relatively flatline month over month. One thing we should know about staff cost, if the revenue goes down, labor cost will go up, right? Because it's percentage to revenue. We're not looking at the dollar amount itself. So as you can see, the summer months were definitely higher on the labor cost side because Obviously, we did not have much revenue generated during those months. And then again, as we get onto the busier season, it sort of flatlines and stays right around 30%. New York and other states being crushed with the new minimum wages, like $16 an hour. It was $8 an hour not too long ago, right? So again, it's something that we have to adjust for. It's something that we have to be cautious about. And we have to make informed and good decisions, obviously, within the restaurants to be able to be sustainable and be profitable. Can we move to the cost of goods sold, please? So here we have the cost of goods sold analysis. Again, flat lines, always good. Unless we see a spike up when it comes to revenue, that's always fantastic. But we'd never want to see a spike up when it comes to expenditures. In cost of goods sold, for example, is flat line. We're comparing its different categories, so it's not just the cost of goods sold altogether. Each color represents a different category in your P&L, right? And these we're looking at the percentages on the left side. So again, we see flat lines all across, except for this blue one that takes a spike up, and it goes all the way up to around 50%. That's a concern. That's a red flag immediately. We want to go back, see what happened. Maybe it's an inventory adjustment. Maybe we calculated, we forgot to include a big expensive bottle of case of champagne, for example, right? So these kind of things can happen. Mistakes can be made by operators. But again, we don't know until we look into it. So at least that's going to give us some sort of metric to look at when we look at the data itself. Last but not least, on this page is the year-to-date operating expenses. These are broken down in some key categories, which we're going to go more in detail during the P&L presentation. But again, it's just giving you year-over-year movement in terms of operating expenses to see if you are within budgets. Because a lot of times we are given budgets as operators, like, hey, you have X amount for operating expenses. Don't go beyond that. So if you are going beyond that, at least you'll be able to track it here, for example, right? So these are just some of the graphs that we include. These can be customizable, but again, it's we feel like it's definitely a useful tool for operators to go off. Yep. All right. So here, an accountant's dreams, numbers, right? And operators, what are probably thinking, what is this? Or at least the 25% are thinking, what is this, right? Don't worry, we'll take it slow. We'll go one step at a time. We'll make sure that we all understand what a P&L looks like and what a P&L is by the end of this session. So let's look at the P&L as a whole first before we go into more granular, right? So there you go. So here, a standardized Paperchase format P&L includes month over month. Then we break it down by quarters and all the way rolling up to an entire year's P&L, right? Another thing we do is we compare the current year's data to previous year's data, and we also give you the variance. So that tells you how you're operating as a business year over year. Again, I always say the terms apples to apples because you don't want to compare January to June. Totally different ballgame. You want to compare January to January, February to February, so you understand how your business is operating as a whole, right? So in this case, in this P&L for this restaurant, current year total revenue. So again, so we have the current year, then we have the percentage to total revenue. So we have the different categories, which essentially tells you what kind of income you're generating and through which categories. Again, this can be catered to your niche. So for example, if you're a coffee shop, your food, you're probably not going to have wine and liquor sales and beer sales. In this case, it's probably going to be bakery, coffee sales, tea sales, and ABAP sales, right? However, for this fine dining restaurant, it's food, wine, liquor, beer. That's their prime income. Well, that's what they're essentially selling to generate their revenue. So again, this can be catered to your needs, and it will be catered to your needs. But we're just looking at a baseline P&L for pretty much that standardized for most of our clients use. So in this case, we're looking at the food sales. So food sales, for example, is 435,000, which is essentially 60% of the total income, right? Again, when the restaurant is built, before that, a budget is created. At that time, we know what our targeted sales is going to be. Are we going to be heavy on food sales? Are we going to be heavy on wine sales? A fine dining, for example, would be heavier on the wine sales as opposed to liquor sales, right? There could be more of a balance, or it could be 60-40 ratio between food and wine, liquor, beer sales, or it could be 75-25. So again, it all caters to your niche and the concept that you are operating out of, right? So food sales 435,000 or 60% of total sales in comparison to prior year, which was 314,000. So again, this. Let me go back 1 second. Or 164,000 rather, right? So one thing to consider is we're essentially coming out of an anomaly called COVID. You know, things change, our lives change drastically, right? So we saw, a huge reduction in revenue and, people going out, dining, etc. So revenues came down significantly. But year over year, when you look at 2022 numbers to 2023 numbers, we should see an uptick in revenues and profits, etc. Right? So in this case, the revenue definitely did a lot better current year than last year. Again, it's not going to be the case for all restaurants, but we're just using this as a hypothetical example, right? All the categories line up to your total revenue. So food, wine, liquor, beer, again, depending on what kind of concept, then we have the room. Event sales, also room rentals, right? Some you may, there could be a photo shoot at the restaurant. You may rent it out for X amount. So that can also be recognized as an income and will show it under your total revenue. So if we scroll down, then we have the negative numbers. What are the negative numbers? Why is it red? Are we not selling? Is this returns? No, it's not returns. It's the discounts given on checks or to our guests and also comps. So although it's not an income, we have to recognize for it, right? So essentially everything here is your gross revenue. Then we consider your discounts and comps, and then you end up with the total revenue, also otherwise known as the net revenue, right? So in this case, 747,000 equals 100% of the total revenue because you're not generating any other income for it. So moving down, again, we introduced gross profit, we introduced prime cost. So here we'll stick to gross profit for now. This tells us our total cost of goods sold. So again, it's a fine dining concept, food, wine, liquor, beer, our prime costs, right? Cost of sales shows in the categories broken down, and then it shows us percentages. So in this case, 747,000 in revenue, $180,000 in cost of goods sold, or 24.1% of total revenue. That is a healthy number. If we can all achieve that, we're definitely doing a great job for the most part, especially running a fine dining concept, right? Rule of thumb, we want to keep that number sub 30, definitely sub 25 for most concepts, right? Again, it's definitely going to be built into your budget, so your team members will already know what the number, what the targeted amount should be, etc. So that covers your cost of goods sold. And then as you can see, we have our gross profit, which is 75.9%, essentially after the 24.1% is considered, which is a healthy number. Moving down to our prime cost, right? Prime cost, which only includes, this addition is the labor cost. Again, as I mentioned earlier, the labor cost can be broken down into two segments: your salaried employees and your hourly employees. Hourly employees can be broken down into sections as well. You have the regular hourly employees and your overtime employees. For example, if a line cook comes and tells you, hey, I'm not going to be able to come in tomorrow, can you take care of it? You as a manager may think, okay, I'm going to have to scramble, get somebody else to cover that shift, right? However, before you make a decision on who to give that shift to, you should look at the schedule to see how many hours that person might have. Is that person reaching that 40-hour threshold? Again, minimum wage is already 16. Overtime rate at 16 is now $24. So that's additional $8 that we're spending for one shift for one person. You also have to consider payroll taxes, right? So overall, if you do that and, every single week somebody is working additional 8 hours, that's $70 a week. Times that by 52, you're looking at about $4,000. That's waste. That's something that could have been controlled just by giving that shift to somebody who does not have 40 hours or who will not have 40 hours by the end of the week. So we definitely want to categorize that on the P&L separately and show it. So this way, you, the managers and operators, can go back and make good, well-informed decisions to be able to take care of all of that, right? So here we see a total labor cost of 30%. Again, great numbers, right? We see this number around 30, sometimes even up to 35, inclusive payroll taxes. So payroll taxes is just the employer portion of the payroll taxes. What the employee pays is the employee's business. This is how much we, the businesses, owe Uncle Sam. Uncle Sam has to get paid, whether we like to or not, we have to give that money to them, right? So that's just the employer portion of it. This is something that the business is liable for, that the business must pay on a weekly basis. Moving on down to other areas of the profit and loss statement. We have total staff benefit costs. Again, it's an employees market, not an employer's market. Employees have so much to choose from. There's a restaurant, 5 restaurants on every block, right? Some offer good benefits, some offer great benefits, some offer no benefits, right? So this is something that we also like to account for to show if there is a benefit being provided to the employees, whether it be staff health insurance, whether it be a 401k, right? So we want to show that as a separate line item on the P&L, and that is essentially where that would be. Moving on down to advertising and promotions. So again, these are all expenditures. Like I said, one key term to look at is the four-wall EBITDA. So anything that happens within the premises of the restaurant will somehow make its way to the P&L one way or another, right? So these are advertising promotions for your social marketing, etc. And then travel entertainment, again, it's self-explanatory, nothing really to mention. All right. So then we come to the meat of the P&L. Within the operating expenses, some categories may include only 2 or 3 GL accounts. When I say GL accounts, it's just general ledger accounts, so disregard that. But it's going to be smaller ticket items, right? Then we move on to the bigger ticket items. So something that is extremely going to be taking and having a big effect on your entire P&L in itself. So for example, linen and laundry, 88.72 or 1.2% for the current year, in comparison to 27.66 to 1%, right? So again, it's a big number. If you can shave it off in half, that's a lot of money. It's $4,000 essentially, $4,400 going back to your bottom line, right? Can it be reduced? Maybe not, maybe yes. Maybe the supplier that you're getting the linen from is charging you too much, or maybe there is a minimum order required with the supplier that you're ordering from, right? But if you look at the numbers and then you're able to identify what the issue is, then you can go back, remedy that situation and make the required adjustment, right? Again, so you shouldn't only look at the volume or the dollar amounts. You should also look at the percentages because it matters. For something like a credit card processing fee, that we know should be right around 3% or less, right? If it's now 3.7%, it's a conversation. It's at least a Kickstarter for you to be able to go back and see, hey, is there another offer out there? Perhaps I can get a better deal or better rate rather, right? So at least it gives us something to go, go look out for, or at least go try to achieve. All right, so that's one example. Another example I want to use here is, for example, the cleaning contract service. So we have 2,800 for the current year, and we had 13,000 for last year. Again, I want to remind you all, when we looked at the revenue was significantly lower last year. So lower revenue, yet higher expense for cleaning contract. How could that be, right? So in this instance, what this restaurant was doing, so they hired a third party, essentially a contract cleaning company, to come in and service the restaurant on a nightly basis, paying a huge amount of money every single week, essentially paying a general manager's salary to a cleaning company, right? They got rid of them. Instead, they hired a porter or like a night cleaner to come in and do this at the minimum wage, essentially. So they were able to shave off $10,000 off the P&L immediately by just doing that. That's bottom line. That's profit. That's money going back to investors, right? So these are just some small examples of how to look at the numbers and how to dissect it to be able to make better, better decisions, essentially, right? So again, I introduced fixed expenses and controllable expenses, right? These are all controllable expenses. These are what you, the managers, you, the operators, have absolute control over for the most part. The contract, the cleaners, the pest control company that you use. The trash and waste, for the most part, is relatively, about the same when you go from one supplier to another. They're all charging about the same rates. But look around. It does not hurt to go back and see where you can save for sure. Supplies, is it required? What's going on with the supplies? Is it the kitchen ordering too much supplies? Is it the office admin person ordering too much supplies? Is it going for a good cause? Are we buying something that we do not need, right? So these are areas that you definitely as operators or future restaurant owners eventually would want to look at, right? Moving on down to repairs, that's something, again, same thing. Professional fees. The thing about the P&L is we want to make it presentable, we want to make it neat, therefore there's so many categories, right? So each category will have sub-accounts which will essentially be somewhere in the ballpark of what the actual parent account says. So at least you will know what it stands, right? So in the total financial costs, we have the credit card fees, we have the bank charges, the payroll processing fees, sales tax adjustment, your general liability insurance expenses, etc. Right. Then comes another big ticket item on the P&L, which is the occupancy cost. Again, rent is definitely going to be up there. New York City rents nowadays is to the roof with people coming back to offices. Office space is not so much, but when you look at restaurants, they are going to get it a lot out of it, right? So we want to go back. We want to see if the lease, if it's a pre-COVID lease, did the landlord consider giving us some sort of waiver or some sort of adjustments during the COVID time? If not, can we go back, see if we can negotiate? Maybe it's outside of our day-to-day duties as operator managers, but again, something that you can bring up to somebody's attention. The first part, occupancy is fixed expenses when it comes to rent. Everything else, utility, like electricity, gas, water, again, controllable in some instances, but not so much, right? So that essentially wraps up our 4-1 EBITDA. Highlight some. Again, everything that I just mentioned up until now is pretty much under our control. It's everything that we can make adjustments to on the fly, right? One of the key skills that I feel like a general manager should have is being able to make on-the-fly decisions, right? And again, that's where it comes handy. That's where it's required. You definitely want to go back, look at this data to be able to make those decisions. Then after the EBITDA comes all the adjustments, like I said before, it's under income, it's cash over short. This is one that is very close in cash over short, just to ensure that cash is not missing, right? Just make sure that your team stays on top of cash. It's going to be easy to lose track of cash. $5 here, $10 here is nothing, but when you add it up, it's supposed to be something, right? Then we have the total bottom line, the net profit loss after the quantity adjustments are made, once depreciation and amortizations are considered. That's the bottom line. That shows how you do it. Again, essentially what I like to say, the P&L is essentially a report card for operators. It shows you how you're doing, what you're doing. The way the accountants puts the numbers for you, present it to you, we can make analysis, we can give you suggestions, but you operators only have to take this data back and be able to make those adjustments on your own, right? So we can give you the guidelines. So hopefully after this session today, you'll be able to go back and make those decisions starting today.
We did have a question about P&Ls that came in. So Katie asks, how can a P&L have over 100% of a portion of sales? For example, wine of the previous year.
It's easily explained. You are not generating enough income to sustain the cash flow going out the business, right? So for example, if what you're purchasing, cost of goods sold, is around 45% of your total revenue, that means you have to look at, may have to go and do some manual engineering, which Giselle can comment on. Your cost of goods sold is high, essentially, right? Your labor cost, if you're not generating enough income and you still have bodies in the restaurant, staff, that you're paying for, but you don't have enough income to be able to pay for that, then money is going to come out of your pocket. You still have to pay your people, right? So overall, those two big ticket items can be somewhere north of 80%. Say it's just a horrible month. Then your rent and other expenses will definitely be there, right? So yes, it is possible for you to not generate enough income to cover all your expenses. Therefore, you can go north of 100% in total expenses. And that would essentially result in a heavy loss for the business for that. So again, just to go back to, there was another point, example, wine of the previous year. One thing I want to tell you is, so when you look at the cost of goods sold, we take, again, the term apples to apples, right? So it's food sales against food purchases. Wine sales to wine purchases. If your wine purchases for the last year was $87.96, right? However, wine revenue was that or another year?
This is last year.
Yeah, so if your wine sales was So it will be an inventory adjustment. If you're purchasing something, you would live in the inventory. It should not go up more than 100%. But you can have a bottom line that essentially does go over, and it can be more than your total net income.
Go
I
ahead,
just have,
Robert.
I just have something really quick. It doesn't really, when I'm scanning invoices to Paperchase, do you know which invoice belongs to which category, or should I be labeling them as labor, beverage, food, and operating?
So great question, Robert. For the most part, we know what they are, given the fact that we have received that invoice from that particular vendor, right? So we know what that item is. Once we understand how you code it, because one restaurant can code a supply to kitchen supplies, and the same supply can now be an office supply, right? So if it's something like that, we'll definitely need to know. But for the most part, when it comes to cost of goods sold, it's pretty black and white for us. We know what the food items are. We know what the beverage items are. Only areas we may need some clarity on if you're purchasing wine that is going to be used in the kitchen to generate a dish, or like limes and fruits or produces that are being purchased for the kitchen that can be shared along with the bar, right? So if it's something like that, we'll definitely need some clarity, but for the most part, we know what they are.
Okay, yeah, that's what I thought.
Can I jump in here as the
Yeah.
operator? Right, Robert, one of the biggest challenges that I see when I'm working with clients is the NABEV. The NABEV is always too high because there are items that should be going to the alcohol category or to the kitchen or are shared. So that's something that I always ask managers to do is if you're sharing an invoice that you have, for example, lime juice that goes to the bar or mixers that go to the bar, that is identified on the invoice. That will help us to give you a much more accurate cost of NABEV.
Yeah, that's why I was asking, because when I order from Baldor or Cisco, sometimes I get sodas in, and that's all for our beverage. That all goes to the bar. But when
So that will help, and if you identify that, that's going to be a big help for us.
Giselle, take it away.
All right, so now you spent almost 20 minutes looking at numbers, and you probably, if you haven't seen a P&L account before, you're probably going, oh my God, how the hell do I master that? And in the beginning is a bit scary. The first time I saw P&L, I had been promoted to general manager, had never seen one before. And I thought, oh my God, what is that? And I had to go back home and find out what a P&L was. So it is a little scary, but after you start reading and looking at the right sections, it's going to become easier and easier. When I look at P&L, the first thing I'm going to look is the top line, the revenue. Then I look at the bottom line. Did I make enough money? Did I make a profit? Then I look at the COGS. I always have targets for the COGS. What should be my food cost, my alcohol cost, NABEV cost, and labor cost. And then I go to labor. These are the main KPIs that I will look straight away. When I look at that and I'm happy with those, then I look at the other lines like cleaning products and everything else. But labor is our biggest challenge at the moment. As we all know, since COVID, it became a huge challenge for restaurants. Hourly rates have increased considerably, and that become very, very difficult to manage restaurants because of labor costs. Now, labor costs is your hourly wages plus your salary wages divided by the revenue. That gives you the percentage of your labor cost. The only thing you can control on that is your hourly wages. The salaries, they are what they are. There's nothing you can do. Sometimes people try to do something that is a big mistake, which is have the minimum amount of people on hourly wages and get the managers to work 60 hours, 70 hours to try and save on the hourly wages. That doesn't work. And I tell you why, because if your people are tired, they're not going to work well. They're not going to sell your product well. It will affect the quality of your product, it will affect the quality of your service. So that is not something that works out. You need to find your balance, and we're going to talk about it a little bit more. When you're targeting labor, it will depend on your concept. We're giving numbers here between 20 and 35% of your revenue. Now, if you are a QSR concept, your labor cost should be around 20%. If you're a fine dining restaurant, you should be looking between 35 and 38%. Those should be your targets. Now, what I do that I found very helpful is to give a target for front of house and back of house hourly labor cost. So when the managers are scheduling, they can look and say, okay, this is how much money more or less I can spend. I normally give managers for front of house between 6 and 8% of the revenue, and for back of house between 10 and 12% of the revenue. This is a really helpful. And if you can keep in between those numbers, you probably will will achieve your targets. Now, when we talk about scheduling, the most important thing, obviously, is find the balance. Because I'm sure you all hear someone telling you that you need to cut labor, you need to cut labor, you need to keep labor low. But how do you do that? You need a minimum amount of people on the floor, on the bar, in the kitchen. How do you know what is your balance? And this is going to be the most important thing for you on scheduling, for you on training your restaurant manager, your bar manager. If you are doing the scheduling, that's what you need to look at. Now, how do you find the balance? First of all, you need to understand your room. If you are the general manager, you probably work on several areas in that restaurant, and you understand how many people you need on the bar, in the restaurant, and in the kitchen. And you need to work with the chef. You need to keep the number of staff that makes the service efficient. So let me give you an example. You don't want to have too many staff that they stand around talking to each other or talking to the bartender, and they don't pay attention to the customers. At the same time, you don't want to have such a little number of staff that then affects the quality of the service and affects your average spend. So you need to find that balance. So how do you do that? First of all, if you are busy at lunchtime, you have to make sure that you have a full, that's too fast. Can you go back? If you're busy at lunchtime, you need to make sure that you have full staffing at lunchtime. If you're busy in the evening, so that's in the evening that you need to worry about. And then you need to look at weather. Does weather affect your sales? So how you need to schedule based on that. It's very important that you understand your room. Remember, the balance that you find. Every restaurant will need a minimum amount of people to run. But at the same time, you cannot compromise the quality of your product and the quality of your service. So if you don't have enough people in the bar, the drinks are going to be slow. If you don't have enough people in the kitchen, the food is going to be slow. If you don't have enough people on the floor, the service will be affected. Now, the other thing that not having the right amount of people on the floor is affected is the average spend. Now, average spend is something that we look at it every week. We know more or less what it is. You have 1,000 people that came last week. They spend $50, and that's fine. But average spend is also the most important tool that you have in your hands to increase your revenue. And we're going to talk a little bit about that. So the average spend is the amount of money that one customer spends in your restaurant. So for example, here we show in the average spend, the revenue divided by the number of people that came through the door. Now, the one thing that I learned, and I always tell my managers, is that when you open a restaurant, when you open your doors, you're going to sell one entree. That's the logical thing. That's what is going to happen. Someone's going to walk through the door, sit down, and order an entree. It's up to us, the front of house, the operators, to make sure that they spend more money, that they, instead of just having a glass of water and an entree, they have a cocktail to start with. They have a glass of wine with their meal. They have an appetizer, and they have desserts at the end. So how do you do that? It's by training our staff, okay? And I know when I say training, everybody say, well, of course we do training. We train our staff. We tell them to upsell. But it's not that simple. If I tell my servers, you need to upsell today. Come on, let's go. Everybody needs to upsell. It doesn't quite work like that, but don't go straight over their heads. What you need is to train them to understand your menu. They need to have the confidence to know the food that they're going to sell, to know the drinks they're going to sell, to know the product and have the confidence to sell it. When they have the confidence, when they know the menu, they know the food, they engage better with the customers. They don't feel awkward about recommending something, because if someone turns around and say, what does it taste like? They can describe it instead of saying, oh, I never had it. So how can I sell something that you never had? A lot of restaurants thinking that doing menu tastings or food tasting for staff is a waste of money. It's not. It's your biggest investment. It's the best investment you can make on your people is giving them the knowledge of your product. So invest on that. I always make sure that before a shift, and when we have a pre-shift or a briefing, I bring a dish for the staff to taste. May it be a dessert, a main course, or whatever, but I give it to them to taste because that's what they're going to sell. Now, the other thing that, I see here in America a lot, it doesn't happen in Europe, is that the servers are going to come to the table with the bill in their hands and they're going to say to me, would you like a dessert? And I will automatically say no. I will get the bill, pay, and go home. So that doesn't work. If you want to sell dessert and if you want to sell drinks, this is an advice that I always give. One, keep your table's bus to the bone. It's something that is an American expression, which means no empty glasses, no empty plates on the table. If I come to a table and I offer a drink and there is 4 or 5 glasses with finish or ice on the glass, I probably will say no because there is too many glasses in front of me. If I have a clean table with no glasses in front of me, 85% of the time, people will order another drink, okay? It's the same with desserts. If I have a big plate of food in front of me and the server comes in and offer dessert, I'm going to say no because I'm still got food in front of me. If you clear the plate and make sure there is nothing in front of your customers, they will probably order desserts. Now, the one thing that we also do is make sure that your staff knows every day what is it that you want to upsell. You have a dessert, a special dessert, let them taste and let them go to the table and offer that dessert. We did that test with a customer a few weeks ago that the sales were very low. Dessert sales were very low. And what we did, we gave it lemon meringue tart for the staff to taste. And they went out that night and offered lemon meringue tart to every single table. The next day, we look at the sales. Only 3 lemon meringue tarts had been sold, but 50% of the customers on that night ordered desserts. Why? Because someone brought up the lemon meringue tarts in a specific item, and the customer maybe didn't like lemon or doesn't like lemon meringue tart, but then they ordered the chocolate cake or the chocolate mousse or something else. So the sales were extremely high on that day. That's how you upsell. It's not by telling your staff to upsell because they're not going to. And you also remember your staff needs to be happy the whole time. So you can't overwork them. We go back to the labor cost. If you're putting someone to work double shifts 3 times a week, by the second double shift, he won't care anymore. Or if you put someone on closing on the evening before, in the morning after they're coming back to work, they're going to be too tired. They won't care about upselling. They're going to be the minimum work possible. If a server approaches a table and say, can I get your order? That's it. You're going to order your entree and that's it. And if that waiter brought you a glass of water, that's going to be your meal. And that's going to be your average spend, very low. Now, if your staff is in top form, they are not exhausted, and they come, they have the confidence of knowing the menu, and they approach the table and say, hey, can I get you something to drink to start with? Immediately you think about a drink, you don't think about a glass of water. Even if you order a soda, you're selling something instead of just giving water for free. So remember, upselling is about understanding your customer, and it's about everything that is around your customer. Full table of food and glasses, you're not going to upsell anything. Bringing the bill to the table and offering dessert, you're not going to sell desserts. So you need to train your staff and you need to understand your staff who are good at doing that, who are not. But most important is give them the taste of the menu so they have the confidence to engage with customer and give a much better service. Dessert is something that every menu in the world has desserts. And sales of desserts normally are between 1 and 1.5%. In Europe, we do between 10 and 12%. That's, a normal restaurant will have between 10 and 12% dessert sales. Why? Because we are trained to sell desserts. We are trained to upsell it in a different way. We know dessert. We taste dessert every briefing, every pre-shift. So that's how you can increase your average spend. Now, increasing your average spend means you increase your revenue without extra cost. And that's very important. That means you don't have to worry about getting extra people coming through the door. You upselling to the people already in your restaurant. So now Ruhel is going to tell you a little bit more about how average spend affects your bottom line.
Thank you, Giselle. So like Giselle mentioned, a lot of upselling is psychological, right? I have no PhD, but I'm an accountant, so we can look into numbers and explain it to you. All right, so say for example, we have 40 covers for that night, right? And theoretically speaking, every spend for every single guest that comes in is $15 a person. Essentially, we're doing $600 in net revenue, right? Only thing we ask the team to do is go ahead and upsell to only 20 guests or half the room, right? So if we're able to increase the sales of those 20 guests by only $10, say it's a dessert and a wine combo for $10, Now, those 20 people only, you would generate us a revenue of $500, okay? So that goes from 300 to now 500. So we're essentially upselling $200 to the same people that are already within our establishments already, right? And the people that did not purchase or did not buy the upsell are the remaining 20 people that would give us $300. So essentially with the same 40 people, we're now generating a total of $800 in revenue. Again, a $200 increase over the 40 people at 15, right? So what it's telling us is more people, and it's telling us is, just by upselling, we're increasing our revenue. And let's look at the same hypothetical. Say, for example, we now have another 10 additional people that just decided to walk in. And they were still spending, and everyone within that restaurant for that night was still spending at $15 every spend, right? That would give us a total of $750, which is still less than the 800 which we would have generated by just upselling to only 20 people. So it's not always about driving in more people to the door. It's more so about attending to the people that are already there, hospitality, being able to be there. And like Giselle said, the psychological effect that it has just by doing the things that she mentioned in the previous slide as well. So Giselle, why don't you talk us a little bit more about KPIs and the beautiful reports that you have generated?
All right. Paperchase created a new division called Restaurant Operations Solutions. And this division is more to work with the operations team than with the financial team. So what we do, we train people to understand financial data, and we created a report that makes it a lot easier for operators to look at the KPIs, the weekly KPIs, and see how they're doing, where they can improve, and where they are having a problem. So the main KPIs on the top of the report are, just one second, please. All those boxes on the top are what I call the main KPIs. Can you please show the whole report so they can see the whole line? Whoever is moving just there. Okay, so the main KPIs are your revenue, covers and average spend, food sales and purchase, alcohol sales and purchase, NABEV sales and purchase, and management and labor. Now, labor we can split between salaries and hourly or between front of house and back of house. So these are your main KPIs that every week you need to worry about. As a general manager, you're going to be responsible for the results on those KPIs. When you see a red box, that means you are under budget. Over budget. And the blue box means you are on budget or under budget. The light blue line here is the budget. So you can see that you have a budget for average spend, you have a budget for food costs, alcohol costs, NABEV costs, and obviously labor costs. So we want you to see week on week what is happening, your revenue. So your target there was 171,000 and the sales are 220. The box is blue. So straight away, when we show these reports to managers, they know how their department is doing. And it's very good. And so everyone that we've been working with really likes this report because of that. It's very simple, very easy compared to the previous week and compared to the previous year. So you know how you're doing. So for example, here, our target here is $135 average spend. They are at 114, but the previous weeks was 121. So, what can we do? And we're going to look at more data below for you to see where is it that you can improve and how it can be improved. We also show the red flags. The red flags are, we look at all the data that you're going to see in this report, and we're going to show some red flags that need to be dealt with. Opportunities, we look at the data and see which areas can be improved based on the data. And we give you a break-even point calculation. A lot of people, you work in the restaurant, you don't know what your break-even point is. So what is it, a break-even? Break-even, that means the minimum amount of money that you need to make per week to pay all your bills, not to lose money. So that will give you not only what your cost should be, but also based on the average spend target, how many customers you need per week to achieve that target. That helps managers to look and say, okay, I made 100,000, at least I paid all my bills. But remember, you need to achieve the same targets in terms of labor costs, purchase, and everything else. It's not just making the 100,000. Then we look at the sales and average spend by revenue center. Depending on how many revenue centers you have in your location, we split the sales and we split the number of covers and what the average spend was on each area. That helps you to look and say, okay, my dining room, I'm doing $114 average spend. and the bar is 120. So that's a little weird because normally the bar should be lower than than the dining room. So what happened in there? Did I have someone sitting at the bar that bought a really expensive bottle of wine? What happened? So I want to know. When I'm talking to customers, I will ask the question because I want to know, was that organically grown? Did they just increase because the bartender is a really good upselling guy that goes and, oh, having a start and have desserts and have that? What happened in there? Then we split sales by shift. Again, we want to see what is your average spend on each shift. Like here, dinner 123, lunch 97. We know that lunch will always be lower than dinner because you don't sell much alcohol, you don't sell desserts at lunchtime. Brunch, fantastic, 126. Breakfast, apparently 0. But you want to see again here, what is it on this shift? So where is it that you can improve? Then we look at the sales by group. Now, I just talked to you guys on the P&L about, each concept has more or less some benchmarks of what the food sales should be in liquor and wine. A fine dining restaurant, their food sales will be between 55 and 60%, and their wine sales will be between 30 and 35% because they are very heavy on a big wine list, expensive wines. So that's what is expected. So this sales by group is good for you to see if you're achieving those targets. You are within those benchmarks. If you are for example, a place that has very loud music and sells a lot of cocktails, your liquor sales should be higher than wine. That's what is expected. If it's not, what is happening in there? So this will help you to engineer your menu as well, to look at your sales. What is it? My liquor sales have gone down week on week. What is happening there? What is wrong? Do I need to review the prices? Do I need to review the cocktails? What is it that is wrong? And then we look at comps and voids, and we show how the comps and voids were done, how much in alcohol and how much in food. Voids and comps are extremely important. For me, if I'm running a group of restaurants that I have several locations and I don't have time to be on each location, that is going to tell me a lot. If the comps are too high, the food comps are too high, what is happening? What is wrong with the kitchen? Is it the food that is wrong? Is delays? What is it that is affecting, that is compelling us to give so many comps? Voids, again, if I have too many voids, that means lack of training. If there is every week server error very high, that means lack of training. So that tells me a lot about what happened in each location that I'm managing. Then we split sales here on this other line of box. We split the sales. Oh, first of all, we split the guest numbers day by day and compare to the previous week. What we want you to see here what's happening day by day, and it is consistent. Every Monday is slow or the Mondays goes up and down. That helps your scheduling. When you look at this, you can then say, okay, I'm always consistent. Monday and Tuesday, I'm always slow. I'm very busy Friday and Saturdays. When I do the schedule, that's how I need to think. But then here, look at that. There was a 400 covers on Wednesday. So what happened? Was it a party? Was it an event? What happened? So that helps you to understand how your business works. Now, this is something very important, the daily spend, right? The daily spend, normally on your busiest days, Friday and Saturday, your average spend is going to go down. Why? Because you need to turn tables very fast. Your staff is running around like crazy. They don't have much time to upsell. So normally we see the average spend going down. But then on your slower days, when you have less people, your average spend should go up. So you can see here, look, Friday 105, Monday 126. That's fantastic. That's exactly what you want to see. So that's how this box is going to help you. And then you go and look at the sales. Again, sales, we compare, this report can compare week on week or year on year. This one is comparing year on year, but you can do week on week as well. So again, here we want to see if your sales, how much are the sales. Look at the different sales between year and year. On Saturday was 34,000, the previous year was 16,000. What happened? So this is the question that you want to ask your managers. If you are managing more than one location, or if you have a location that is affected by weather or is seasonal, you want to compare that year on year. If it's a location that is quite relatively consistent, you can compare week on week. But you want to see your sales, what's happening. You want to compare to something else, but you want to ask your restaurant manager, what happened there? Did we have a big event? What is it that affected us? Was it the weather? Why the sales went down? Okay, so then we look at the average spend per hour. This is where we're going to look at where the opportunities are. Okay, lunchtime will always be lower than dinner. So what can we do at lunchtime in terms of engineering the menu to improve those sales? Can we create set menu? Can we do petit fours? I don't know if you guys know what petit fours are, but they are little sweets that instead of selling dessert, you can sell just those little sweets with coffee. What is it? Mocktails. People are not drinking alcohol at lunchtime. Can we do a really nice mocktail list for that? So what is it that we can do to improve the average spend at lunchtime? Then we look at the sales, but we split the sales into food, alcohol, and wine. We do day by day, and then we look at the average spend. So the average spend on food on the other side, can we please move to the right? Here. Now, this is really, really important, and I love this. I'm a data addicted. I love when I see this, because what tells me here is that, am I selling what I'm supposed to be selling? So if you create your menu, you should be having in mind, what is it that you're supposed to be selling? One entree and one appetizer per person. Let's say you are more of a fine dining or a upscale restaurant. So that's what you're looking for. Entree and an appetizer, at least in terms of food. So is this food average spend what you aim for? Is that your target there? Now, this is compared to last year. So between last year and this year, there was an increase of 15% on menu prices. So is that being reflected on the food average spend? Again, that's what you need to look. And if it's not, why not? What is affecting that people are not eating as much? Something wrong with the menu, they're not ordering side orders because the side orders are not very exciting. So this is going to help you a lot to see how your menu is doing. Then we go into alcohol, right? You look at your alcohol average spend. Again, what type of restaurant are you? Are you more of a fine dining restaurant? Okay, so your liquor sales are going to be a lot lower. So what they see here, you see $8. That means a third of a cocktail per person. Okay, so let's look at the wine sales and see what the difference is. This is very low, six. So let's look at the wine sales now. Okay, so here we look at the wine sales, we split, and then we look at the average spend on wines. Look at that, is at least a glass per person. So that means this place is more of a wine place, it's more of a fine dining place where people are going to come in and have at least a glass of wine per person. So what should be your target there? In my experience, a fine dining wine restaurant, I would aim for at least 1.5 glass of wine per person. That means it should be above the average of your house wine by the glass. So that's what you're looking for. Again, that's how it helps you. It also gives you here the cost of the wine itself, that's 15% on that week, the alcohol and the food is going to give you on those graphs. Okay. Then we look at labor. Again, labor is our challenge. We're always struggling with labor. So we do a comparison. We split labor into management, back of house, and front of house. We then compare week on week or year on year, depending on the client. What we want to see is, how, if the sales improve, we expect the labor to go higher. But you want to make sure it doesn't go too high, because one thing that I keep telling clients is there is only so many waiters you fit on your room, or only so many cooks that fits in the kitchen, only so many bartenders in the bar. So if your sales go up 50%, it doesn't mean your labor should go up 50%. You see what I mean? That's when we go back to balance that we talked previously. It's very important for you to find your balance. When you get busier, it should go up a little bit, but it should not go up too much. That's very, very important to find our balance. Now we look at the labor cost day by day. Again, this is very important. What we want you to see here is how much front of house and back of house is costing you every single day of the week. You can get that from a POS system, but we know we don't have time to be looking at thousands of different reports on a POS system. So that's we give you with a little, very beautiful graphic, very colorful, much easier to understand. And you can see the percentages here, 16, 12, 17, 16. So that's where you want to be. Remember, we talked about the target being 6% for front of house, 10% for the kitchen. This restaurant is achieving that. And that's how you want to look at this graph for labor. Then we show you the top 20 selling items for food, desserts, NA-bev, liquor, wine by the bottle, and wine by the glass. Why is this important? These are the items that you're selling the most. So these items need to have your best margins. These items you need to make sure that the ingredients go up. You need to look at this list and say, okay, butter is going up 20% on the price. So now how many items on my top 20 selling items are using butter? How many are going to be affected by that? Which items do I need to put the price up? That's how you keep that. This is the easiest way to keep track of your margins and what items you need to worry about the price. So when you, again, for example, let's say you want to change your menu and you want to put the prices up. So what, instead of looking at your menu, say, I'm going to put 20% up on the whole menu. No, look at these items, look at your 20 top selling items and increase the price on those 20 top selling items. So when your customers come to your restaurant, they look at the price, it's not the whole menu that is, okay? It's just some items that have gone up. Also, when you increase in price, don't just increase price on the menu the way it is. If you can, change the positions of the dishes, because what you don't want is for a customer to regular to come in, sit down and go, oh my God, oh, the prices are going up. So change the names, change a little bit, add some new dishes, make it look slightly different so it's not such a shock. And again, look at those items. These are the ones you want to see, that you want to make sure. That is a very famous, in the economy, that is a very famous 20 rule, which means if 20% of your business have good margins, it will pay for the 80% that is on the background, that is not selling as much. So these items are the ones that are going to help you to achieve that. And then at the bottom of the report, we do a P&L account. The P&L account, we want to show you week on week if you're achieving your targets and how much money you make. Because sometimes, you know, I remember showing it to some clients, and the first time they see, the restaurant manager was like, oh, we made 150,000 and we didn't make any profit. So that's when you start to understand how important it is, the labor costs, the purchasings, you know, everything that we talked about before will affect that bottom line. You don't control your purchase. You buy too much wine, you buy too much beer every week without looking at your sales on the previous week, you know, it will affect your bottom line. Your labor cost is too high because, you know, you just want to have lots of people around to make sure that nothing goes wrong. I hear that a lot. Oh, but I have to make sure that I have enough staff for nothing to go wrong. If you have the right staff and if your staff is trained, nothing is going to go wrong. They're just going to get the job done. And you need to give the knowledge and the training for your staff to achieve that. It's not about quantity, it's about quality. Always remember that. And then we look at the voids split by reasons, and we look at the comps split by reasons. So you want to see here, you had the $4,000 in discount on food discount. What happening there? You know, always ask managers to explain to me why is it so high. So this is a 2-page report, and when we go through with clients, it normally takes 30 minutes, and it's very helpful. You know, it's more an operational report than a financial report. And I'm happy to take questions on that.
How do you understand gross profit in terms of percentages? For instance, 85% gross profit is 85% of what? Total profit?
Total revenue.
Total revenue.
So gross profit is cost of goods sold against total revenue. However, you can still break it down into different categories, right? So it's food cost against food sales, wine cost against wine sales, etc. So that can be totally looked into by different categories, but when we're looking at the gross profit, we're looking at the gross profit as a whole. So it's a total revenue against your total cost of goods. Great question.
We've got 2 more that are kind of similar. And is ROS an added fee or service Paperchase offers, or is this a standard financial?
Yes, ROS is an added service that Paperchase offers. We do the report and then we train the team to understand the report and to use the reports afterwards without us.
Hi, I guess this question is more so for Giselle. Kind of in your expertise and in the years that you've worked through various P&Ls, the question would be, is there a best practice for reviewing your business? So in my experience, I think it's usually like week to week. I'm seeing some of the reports on ROS are like year to year or month to month. In your experience, is there a best practice? So would you do month to month, week to week? Do you stagger as the business staggers, or what does that look like?
I prefer week on week, and that's one of the main reasons that I have worked with Paperchase for 20 years is because they used to be the only accountants to offer a weekly report. And that gives me a lot more control on what is going on. The one thing that I learned, a weekly report will not be 100% correct. Okay, so if you see your gross profit, your GP there, your food costs or whatever, it will not be the same as the monthly because you're gonna get more invoices when you're doing your monthly financials than you get on the weekly. So there is a little bit of discrepancy there, but it gives me control on everything that is happening. I know what my bar managers, head chefs are ordering. I know if they are more or less within budgets. So for me, week on week is extremely important. Now, some clients do the year on year because it's seasonal restaurants. Okay, so if you're very busy, very, very busy in the summer, that's most 80% of your business is done in the summer. You want to compare with the previous summer, not with the previous month or the previous week. So that is the difference. But for me, weekly reports is a huge help, and I highly recommend that.
Hello, Giselle. I have a question for you. Okay, I'm in New York City, and I've seen many restaurants sometimes that are very busy, but at the end of the day, they end up closing because they don't make money. And I've also seen some restaurants that are just fairly busy, and they've been there for years. Now, sometimes I ask myself the question when I say that, I ask, what caused the busiest restaurant who's very busy that end up closing because they don't make money, and the other end, the other restaurant who's not that very busy but that end up making it? What's the difference between them? And if you were hired to consult both of them, where would you start?
All right. One of the things that I see a lot, Seidu, is when a restaurant is very busy, they have too many staff, they buy too much, and that's where their cash flow goes, that's where the money goes. They're very busy, so they always keep overstaffed. They overstaffed in the kitchen, they overstaffed on the floor, on the bar, and they keep buying. They don't buy. I always say to managers, buy what you sold. Look at your last week, look at your inventory and see what you need and buy that. But when a place is very busy and the people don't have that knowledge, what they do is they keep buying the same amount of things every week, independent if they're going to use or not. So if they buy, 10 kilos of Wagyu beef every week, even they don't sell it, there is a lot of waste in there. There is nobody controlling. That is one of the biggest causes of restaurants being very busy and not making money, is not controlling the KPIs, the labor costs, the food costs, the alcohol costs. If you don't control those things, the money is going to go down the drain. It's going to come in and go out immediately. So this is what I see. Now, the places that are not so busy and do well, they probably are controlling their KPIs. They maintaining a very tight ship, like what they say. They don't spend any money that they don't have to. They don't have huge stocks. They don't have huge wine lists. I see, sometimes a restaurant opens a small restaurant and they hire a beverage director. And it's a small little restaurant. And why do they need a beverage director? That costs money. A beverage director is going to be on a high salary. That means he's going to be buying a lot of spirits and liquors and wines. But, is that what you want? First, why don't you start small and grow with your business? As you get busier, then you increase your wine list or your cocktail list. But, be aware that everything that you do has a cost, and that cost is going to affect your bottom line. So when I'm advising clients, that's the first thing I look. If someone comes to me and say, hey, we're really, really busy, but we're not making money, immediately I want to see what their labor cost is, how many people they have on the floor, to look at their schedule, to see if they really need that many people. I had a client that a year ago that, they had a kind of a coffee shop. They were not making much money. So we looked at their labor, and they had this huge pastry department in the restaurant that they didn't really sell that many pastries. So, that what was wrong. The pastry department was costing more money than the regular cooking department. I hope that helped you.
So thank you so much for joining us. We really appreciate it. And we will see you in future sessions. Thank you.